If you're thinking about diving into investing but don't know where to begin, you're not alone. A lot of people feel the same way, overwhelmed by all the financial jargon and the fear of making the wrong move. But here's the great news. You don't need to be a financial expert to create a profitable investment portfolio. In today's video, I'm going to guide you through a straightforward, step-by-step process to build a massive dividend portfolio that can generate consistent income. The best part, you don't need a fortune to get started, and you don't have to be an expert either. I'll break it down into 3 simple steps: how many stocks you should own, how much to invest in each one, and how to diversify your portfolio across different sectors. By the end, I'll show you exactly how I selected 17 top dividend stocks for my own monster portfolio and demonstrate how a one-time $25,000 investment could potentially grow into a $2.5 million portfolio. That's a 1,000% return. Plus, it could generate over $70,000 in monthly dividends. But before we jump into how to build this monster dividend portfolio, let's first understand why having such a portfolio is essential for generating steady income and managing risk, especially when starting with a small investment. Inflation and market risks are 2 major hurdles you'll face when investing. They affect your returns, and if you're not careful, your investment might not keep up with inflation over time. For example, a $1 million bond portfolio earning 5% annual interest would give you $50,000 in yearly income. But after inflation and taxes, that income could feel more like $25,000 in today's money. And that's just not enough to live on comfortably, right? This is why having a diversified portfolio is key to both minimizing risk and maximizing returns. By spreading your investments across different companies and sectors, you avoid the risk of putting all your eggs in one basket, like what happened with Enron or Lehman Brothers. Having a diversified portfolio means you won't depend too heavily on any one company's performance. So when one stock drops, others may rise, helping balance out your overall risk. And even if the market has ups and downs, historically, long-term investments tend to appreciate over time, making your portfolio more resilient. While it's impractical for an individual investor to buy shares of every company, using ETFs, exchange-traded funds, can help. Now let's get into how to actually start building your own portfolio. The first question to ask is, how many stocks should you own? To maximize diversification, it's crucial not to concentrate your investments in too few stocks. The rule of thumb is that the more stocks you own, the less risk you take. A study by the American Association of Individual Investors showed that owning 25 stocks can reduce risk by 80%, and holding 100 stocks drops it by 90%. If you want to be even more cautious, owning about 55 stocks can reduce risk by 90% even during market downturns. But as individual investors, we're not looking to overcomplicate things. For most of us, owning between 10 and 25 stocks is a great way to ensure a well-diversified portfolio while keeping things manageable. So, once you've figured out how many stocks to own, the next question is, how much do you invest in each one? It's tough to predict the best performers, so my strategy is to evenly allocate your investments. This minimizes the risk of betting too much on a stock that might underperform. For example, if you have $10,000 to invest and want to buy 12 stocks, you would allocate about $833 to each one. Now let's talk about sector allocation. Even though owning more stocks reduces risk, your portfolio can still end up being poorly diversified if you invest too heavily in one sector. Stocks from the same industry tend to move in sync, meaning if one sector struggles, the whole portfolio could take a hit. To avoid this, I recommend limiting your investment to no more than 25% in any single sector, ensuring you're spread across different industries. Diversification is important, but it should never come at the expense of buying overvalued stocks or investing outside your comfort zone. For instance, don't feel compelled to invest in sectors you don't understand just for the sake of diversification. If a certain sector feels too complex or uncertain, it's okay to pass on it. Stick to companies and sectors that you know well and where you can make educated decisions. Once you've decided how many stocks to own, how to distribute your money, and how to diversify across sectors, you're ready to start building your portfolio. I've handpicked 17 solid dividend-paying stocks across a variety of sectors for my monster portfolio. This includes stocks from industries like energy, healthcare, real estate, finance, and technology. These stocks are carefully selected to ensure diversification and consistent dividend income. Now let's get to the exciting part. Imagine starting with $25,000 in this portfolio. Over time, through a combination of dividend income and capital appreciation, your initial investment could grow into something much larger. After 10 years, your $25,000 could grow to over $113,000. After 20 years, that could skyrocket to $528,000. And after 30 years, that could reach $1,280,000. 30 years, it could potentially hit $2.5 million, generating around $72,000 in yearly dividends. So if you're ready to get started and want to know how this strategy works with specific stocks, keep watching to learn more about each of the 17 picks and how they can help you reach your financial goals. If you found this guide helpful, don't forget to give this video a thumbs up, leave a comment with your thoughts, and subscribe to the channel for more tips on building wealth through smart investing. Thanks for watching, and I'll see you in the next video.